Hello and welcome. You're watching the Business News brought to you by Blytheway. I'm Charlie Gibson. Now, there are several, as we know, very rare things in the world. Gold is one of those very rare things, and arguably an even rarer one is a gold mining company that pays a dividend. There are only about 62 globally precious metals companies that pay dividends, but we have one of them in the studio today. And it's my very great pleasure to welcome the CFO, Mark Learmonth. Mark, very good morning to you, and also the Vice President of Corporate Development, Maurice Mason, both, I should say, from Caledonia Mining. Gentlemen, welcome. Thank you very much indeed for joining us this morning. You had your second quarter results out very recently. Can you just talk me through them?
Yeah, we put them out yesterday, and they were a very, very creditable set of results. Production pretty much where we expected it to be for the first half. Pleasingly, operating costs coming down a little bit, largely helped by the devaluation of the Zimbabwe dollar, but not just that. I mean, quite good cost control. Head office costs down again a little bit, not by accident. A lot of effort goes into bringing those down. And then at the operating profit level, we made an enormous foreign exchange gain of $20-odd million, which was largely driven by technical reasons relating to the devaluation of the Zimbabwe dollar, in particular the restating of the deferred tax liability, which typically makes most people glaze over. But the genuine fact is that at the moment, right now, this quarter, last quarter, the previous quarters, we've been getting a real tangible benefit from the fact that we're spending $4 or $5 million a quarter, and that expenditure is reducing our income tax liability in Zimbabwe. But we don't have any. The payback for that is only going to arise when we actually bring those assets into production in 2 or 3 years' time. And so effectively, this is a monetary asset, monetary liability, and $20-odd million now gets devalued down to $2 or $3 million. So that gives rise to a very, very significant foreign exchange gain. Also, other things that contributed to that were the fact that we now recognise the amount we owe to the local electricity company as a local currency liability, not as they wanted a US dollar liability. So there's another $4 or $5 million there, and that also flows through into helping to bring the costs down, because instead of paying 12.8 US cents a kilowatt hour, we're paying the same in local currency, which is now not very much at all. So the results were very creditable. We're very pleased with them. Cash generation remains very strong for the time being, as does our capital expenditure program. But absolutely where we expect it to be, and we continue, as you point out, we continue to pay a quarterly dividend of just under 7 cents a quarter, 27.5 for the year.
It wasn't all quite plain sailing. I want to come back to the Zimbabwe dollar in a minute, or maybe we should call it the new Zimbabwe dollar, I don't know, but let's come back to that in a minute. But you reduced your guidance, your production guidance for the full year. So when I say not all plain sailing, there were some trials and tribulations.
Yeah, the reduction, the production guidance was previously 53 to 56,000 ounces. We brought it down to 53,000. We shaved 3,000 off. And actually, that doesn't reflect what happened in the first half of the year. That reflects what we expect to happen in the second half of the year. So if I'm talking narrowly about the first half, production for the first half was a few hundred ounces less than we'd expected. The difficulty we have looking forward for the balance of the year is in the first 6 weeks of the third quarter, so 6 weeks really until last Friday, we were suffering enormous power outages at the mine. And power load shedding, which may not be a term that people in the UK are familiar with, but certainly coming from South Africa, load shedding is part of life, which just basically means the country runs out of power and they ask or they just turn users off. So if you're a residential customer in Zimbabwe, you'll have been suffering power outages of 18, I think now up to 20 hours a day. They tried to protect the gold producers for as long as they could, but pretty much from the 2nd or 3rd of July onwards, Blanket Mine was suffering outages of anything from 8 to 10 hours a day, which means that without electricity, we can't produce gold. We do have backup generators. They're terribly expensive. So in July alone, we used 265,000 litres of diesel, which is terribly expensive, and that's not a long-term solution. So production, notwithstanding the fact we do have standby generators, production in July and the first part of August was badly affected by electricity. Happily, last Friday we signed a new power supply agreement with the government supplier.
Is that, if I can put it, is that worth the paper it's written on?
We hope so. No, we think so, because one of the things that genuinely came out of the interactions we had with government over the course of the last 5 or 6 weeks is government absolutely understands, and the Ministry of Mines, the Ministry of Finance, and the Reserve Bank absolutely understand that they need the gold industry to continue to produce gold to earn the foreign exchange to keep Zimbabwe afloat. And having no electricity isn't part of that parcel. So you say, is it worth the paper it's written on? We see a very clear commitment from government to get a long-term solution here. So happy to have that agreement in place. The other, but you say, is it worth the paper it's written on? We all know that the electricity supply and demand situation in sub-Saharan Africa is precarious, likely to get worse if this situation in Zimbabwe, in South Africa, gets worse, because Eskom is a major supplier up to Zimbabwe. So in that context, we're now very advanced in evaluating the first phase of a solar project, which would go some way towards reducing Blanket's reliance on the grid. And first phase would perhaps provide half of what Blanket needs. Second phase would be a bit more complex, because we need to put in place various agreements to what to do with sort of temporary surplus peaks in power production, but very much looking to see what we can do to try to de-risk Blanket from an electricity supply perspective. But then the other reason why, to go back to renewable, but the other reason why we shaved production guidance is we're continuing to experience grade issues. So the grade that we're getting at the mine continues to be less than planned, and that's largely because we are not developed into the higher grade areas that we expected to be in at this stage, which also goes back to electricity supply problems, because when we have interruption to electricity supply, we have enough power to maintain production, but not enough power to maintain production and do development. And so typically in those situations, you focus on tomorrow's production, not next week's production. And so we took it upon ourselves to just shave back production guidance a little bit, but no effect on earnings. Earnings guidance for the year stays as previously stated, so I think 84 to 117 cents a share, because notwithstanding a slightly lower production, slightly higher gold price, and lower costs. So no real effect.
If I can just extend the conversation out to the broader, if you like, environment in Zimbabwe. You talked about the power supply problems. Now, if there's a shortage of power, I'm guessing there's a shortage of other things as well. Consumables. You talked about your diesel consumption. Is there enough fuel in the country to keep you supplied if that's what you need? Maurice, can I come to you, just ask you about the broader situation in the Zimbabwean economy?
Yeah, Charlie, the most significant thing, and you see it in our results, is the currency issue. The Zim dollar experienced a tenfold devaluation in the first half of this year. So
just back to the old days, because we remember the old Zimbabwe dollar. That when I still have $100 trillion of old Zimbabwe.
No, so yeah, we don't think so. Fundamentally, the root causes of the inflation are different. So if we go back to before February this year, Zimbabwe was maintaining a currency peg, and maintained that currency peg really since the old Zim dollar collapsed in 2009. The root cause of the problem is they hung on to that currency peg for far longer than they should have, and eventually that currency peg broke, like all currency pegs do eventually, in February of this year, and the devaluation then from effectively a 1-to-1 exchange rate to what at the moment is about a 10-to-1 exchange rate. It seems to have stabilized at around about 10-11. We'll see. It's obviously a volatile situation. We're a gold miner and we report in dollars. So the underlying results of the business is probably a mildly positive impact in terms of the costs, as Mark mentioned. But I think it's important for investors to note that the underlying causes of the inflation this time, I know this time is different, is a dangerous thing to say, so that's not lost on us, but the underlying causes of the inflation are different. There's no money printing. The government's not monetizing any debt. The government is running a primary budget surplus and has been doing so since, I think, September, October 2018. Budget surplus is $100 million in recent months, per month. So the government are taking some bitter medicine, I think, and we think long-term that is likely to have positive effects. They've raised central bank overnight lending rates to 50% per annum to try and constrain bank lending, constrain bank leverage. So the situation is fundamentally different to the monetization of debt that happened under the previous administration. and back in the 2009 days.
Does that affect your workforce, that sort of
It,
environment?
Yes,
it did. It did very dramatically when the peg was maintained. So when they were holding on to this peg at 1-to-1, and the rate in the street was clearly closer to 5-to-1, and we pay at the official exchange rate, that was a very, very serious effect on morale, and it was difficult the first few months of this year. We've effectively been able to give our workers in Zimbabwe dollars a 10-fold pay increase to today from January this year, for the simple reason that we pay at the official exchange rate. But as the devaluation happened, the official exchange rate was in some cases slightly behind what was perceived to be the street rate. Again, when the situation is as volatile as this, it's difficult to get a clear view, but morale in the mine certainly improved, and rightly so. I think if I was getting paid 1/5 of my salary, I would be justifiably unhappy. So it's got a lot better in the last 8 months, but it was difficult in the beginning of the year.
But we can't pretend the blanket's an island, okay? So whilst we've done what we can to protect the position of our workers, you got to understand that if you're not one of those lucky people who works for Blanket Mine, if you work for, say, the government, the Ministry of Mines, and you're a regulator, or the tax people, the people who you need within government to do the things that have got to be done to make business work, it's very, very difficult for them to work when their own spending power has been reduced significantly, when they've got no power. When the only time they got power at their houses is between midnight and 4 in the morning. And so what we have seen is a slowdown to a standstill in the sorts of regulatory processes that we need to get seen to be done. In particular, case in point would be this transaction to buy out the 15% of Blanket Mine that's owned by one of the indigenous partners. We need approvals from the Reserve Bank and the counterparty. They need a tax clearance. And just trying to get the administration to get them to do this stuff is becoming incredibly complex. So you can't pretend that's not a problem. You asked about the availability of the stuff we need. Pretty much everything that the mine uses, we can bring up from Johannesburg, and increasingly we are, because we did try very aggressively to procure as much as possible locally. But if you're finding the pricing for local products is out of kilter with what we can import it for from Johannesburg, we can't justify using local supplies. Diesel, it was a struggle. And we probably bled the system dry, I think, in the course of July. So that was not a sustainable long-term solution. Had we been continuing to use diesel for month after month after month, I think would have found it impossible to get the amount that we needed. But we managed for the period we needed it.
Okay, we talked about a lot of sort of complex things, shifting things, and difficult to predict. And I might quote Yogi Berra and say forecasts are difficult to make, especially when they're about the future. The one thing I think we haven't talked about so far, the elephant in the room, is actually the central shaft in the ground, isn't it? Which is now complete.
Very, very pleased. We're very, very pleased that in July we announced that we've finished the shaft sinking process. So we started sinking this shaft in early 2015, and now we've got a hole in the ground that goes from surface down to just over 1.2 kilometres. So that's 3 times deeper than the shard is high, which I think is a very useful way of looking at it. At the moment, that's just a dirty, bare hole in the ground. It's not concrete lined. So we've now started the process of equipping that shaft, which means putting in steel work so that we can support the infrastructure that's needed to operate the lift systems, a 4-compartment lift system. That started, and that will be finished, broadly speaking, this time next year. So sometime early in the third quarter of next year, I'd hope. Which then means that we can start to. We've already begun the development away from that shaft, and so that means that pretty much as soon as that shaft is equipped and operational, we can start to rack up production from these new areas, which will then see production start to increase very smartly from the current levels, the 50-ish thousand ounces a year, up towards 80,000 ounces a year by 2022, and that's on its way. It's really happening.
Could that happen just a teeny bit earlier, do you think? Because middle of next year is still 2020.
Middle of next year is 2020.
So could 2021 be running up?
No, equipping the shaft is. I don't want to underestimate the complexity of that. That shaft isn't concrete lined, okay? So the benefit is that it's cheaper to do. Mm-hmm. Concrete lining a shaft will be very expensive. The disadvantage is that now we do not have a uniform cylinder going into the ground. It sort of, in certain areas it's wider, certain areas it's narrower. And so putting in the steelwork means that you've got to fly a drone down the shaft, take measurements every 5 meters or so, cut the steel to that specific length, and then put the steel in that specific position. And that will be an exercise, okay? But it is quite complex. I'm confident we can do it. So I don't think we can do it any more quickly.
Okay, so 2020.
Timing-wise, 2021,
Yeah.
we're expecting 75,000 ounces.
Okay, so you're almost there.
Almost
Yeah,
there. I mean,
almost
and then 2022 is 80,000 ounces.
But look on a
And-
quarter-by-quarter basis. This blanket mine is highly volume sensitive. Okay, so as volume increases, as we get more gold out, the fixed costs, which are quite high now, the fixed costs are about 2/3 of the overall cost base. That brings your average unit cost down quite a bit. The capex falls away very smartly, and so the free cash generation just increases. Then that's even before you start looking in factoring in the benefit of the current gold price. So we are within 12 months. We can smell the money coming. We can see it coming towards us, and it's after five years of spending thick end of $20 million a year. Bring it on, eh? Bring it on.
All right. On that note, I'm afraid we're going to have to draw it to a close. Gentlemen, thank you very much indeed. Ladies and gentlemen, that was Mark Learmonth there, the CFO of Caledonia Mining, joined by his Vice President of Corporate Development, Maurice Mason. As I say, that's all we've got time for. Caledonia Mining, you can go and take a look at it. You could have bought the shares a month ago for £4. You can buy them today for about £4.80. So what's that, 20% uplift in the space of a month? Not bad going, as they say. As I say, I'm afraid that's all we've got time for today. This is me, Charlie Gibson, signing off. We'll be bringing you more such investment ideas in the very near future. Until then, you have a capital day.